To fix or not to fix? What is best when it comes to interest rates on long-term debt? You buy a property, you've got a 20-year mortgage. Should you fix the interest rate so you know that you've got regular payments coming in for a period of time? Or do you take a little bit more risk and ride the interest rate cycle? Now, 5 years ago, it made a huge amount of sense to fix at incredibly low rates. Interest rates around the world have rocketed over time and are showing very clear indications of ameliorating. Do they ever go back to the record low interest rates of the previous decade? Possibly not. So what do we do, Warren Ingram, certified financial planner?
I think it's important to understand the interest rate environment that you operate in before you make the decision to fix. So as you said, if we're in an environment where interest rates are likely at their peak, and are likely to come down, whether they come down 0.5% or 3%, it doesn't really matter. The point is, there's a general view that they will come down. Then I think your intent should be to stay as flexible as possible. So if the bank is pushing you to lock in a fixed rate for 2 or 3 year period, or even 5 or 6, I think you resist that as much as possible, and rather allow that interest rate to float. In other words, allow it to move along with the prevailing interest rate conditions. And equally, if you're in an environment where interest rates are at 10 or 20-year lows, then you try your best to lock in a fixed rate for as long as possible, because what you know is interest rates at some point will go up.
Banks hire very smart people called actuaries to look at all of the world's probabilities, and as best they can, they work out their risk profile, and they're going to offer you a fixed mortgage at a rate considerably higher than the prevailing rate, because they do not want to take the risk, of course, of an unforeseen event, the black swan event, as Nassim Taleb put it in 2008, 2009. So they're very smart at this stuff. You've got to work out, and again, it comes down to your money personalities we spoke about a few weeks ago. It comes to your risk appetite, your tolerance for the volatility and the changes of interest rates, and your ability to ride out reasonable rate fluctuations.
So I think, when you make the decision, understand that, you can allow the rates to float, and a little bit of uncertainty might be unsettling, but financially could be an incredibly good decision. And as you say, you're never going to kind of bet against the house and win every single time. The way to win in a situation like this is to suit the position to yourself, suit it to your time horizon, your capability to deal with a jump in interest rates or a fall, and how can you tolerate that financially, and then make a decision that suits you. And that's the only way I think that the ordinary Joe like you and I can beat the big institutions. Is we have one thing they don't. We have the knowledge about ourselves and what we need to do for our money.
So what action can we take here, Warren?
Understand the difference between the fixed rate that you would pay if you were to lock in and the floating rate. What is that differential at the moment? So if a fixed rate is 3% more than what you would pay on a floating rate, understand that cash flow implication and how much, how many changes of 0.25% a year would be required for you to start winning to make up that 3% difference. And it's a lot. So then it doesn't make sense to fix. Whereas if you're in an environment where it's only 0.5% and it therefore requires 2 decisions by the reserve banks to move you into the money, or at least neutral, then it becomes a very good decision. So I think understand the gap, and then make sure you understand the interest rate environment that you're in. That takes you 3 or 4 articles on the internet to understand, are you in the peak of an interest rate cycle, at the bottom? It doesn't matter if you're somewhere in between. What's the big trend? You don't need to be exactly right. You just need to be reasonably right on this one.
Warren Ingram, certified financial planner. To fix or not to fix? That's going to get you into a fix.